The following is a presentation of TFNN. Live at TFNN. The Money Masters. Now, the Money Masters.
Hi, everyone. Basil Chapman sitting in for Steve Rhodes and Tom O'Brien, the Money Masters. My pleasure to be here. And kicked off the day. Tom started off the day, in fact. If you want to listen to Tom O'Brien, came on 9 o'clock till 10. Most, and there's Eastern time, of course. Most important, you want to go TFN, and I'm sure we'll have it up there on the front page. Tom's interview this morning, great interview on CNBC. As always, Tom was the guest and discussing gold, discussing different parameters that he's looking at and why he's looking at it. Very perceptive, and it was received very well. And congratulations, great interview. So let's just look at this market right now. In the overall spectrum, what we're finding, if you look at the different chart patterns in the Dow and the S&P, is that we've been rising against a backdrop, first of skepticism, and now some belief in the concept that the market is going to go higher. My suspicion is that we have seen the public starting to come in at a different level than almost any time since March of 2009. And one of the reasons being that there's a very good chance that, because if you listen to the mantra that people regurgitate over years and years and years, you will find that the more that the press, and I include all the different media, different mediums and media, the more that they repeat a particular slant, bent, or an exposition of something that is happening in the markets, in the world economies, etc., the more that it is on the front page, not the back page, but on the front page, the more and more and more you could interview as many people as you wanted, and you will find that there's going to be an increase in people essentially parroting what they've heard. For a majority of the time, and I don't mean a majority of the time, 51%, I'm implying up in the 90% area, that when the public finally, everyone, you can just stop anyone in the street, and if they know anything at all about the subject matter, a lot of people actually know nothing about any subject matter that has to pertains to the economies and other things to do with the country. They're just doing the job. They go to work and come back, go to work, come back. But if you ask them and they've heard news, then their bias will be to probably tell you exactly what you've been hearing day in and day out. And with that belief in mind, I suspect that we are looking at a period now where the mantra is going to be money is coming out of fixed income and going into higher risk areas like stocks. They won't say that. What they will say is money seems to be coming into the stock market. That gives you a certain parameter. It allows you to consider that at other times, April-May period of the last couple of years, it's when the public has come into the market and whoosh, there's been a very steep decline. Some a little steeper than the others. One was about 18% in the Dow, 17, 18, and one was less. But most importantly, that was the time period. The time period that normally is sell in May and go away. Okay. I actually don't see any reason why that shouldn't occur this time as well. It's just a very big difference. And I'm going to go through that here. In the charts that I'm showing you, let me just run the numbers. The Dow the Dow is unchanged at 14,396. The S&P is down just 2 points at 1549. Comp Index is down 6 at 3238. I always like to look over to one of my screens here. Yeah, Apple's down 5 at 426. So that's putting pressure on the Qs. Gold is trying to form some kind of a base. We're going to have a look at all these charts. There's plenty of time. We've got 2 hours. We've got this show and then my usual show, which is 11 o'clock until noon, called the Tiger Technicians Hour. So here we go. Oh, and don't forget, 877-927-6648. That's the number I want to hear from you. Please call in. So we're going to go back to gold, and we're going to say gold's at 1579 up to. I'm going to show a pattern just now called... Always, I have to name these patterns. I'm going to have to start naming them very much more sophisticated. But I call it the dreaded H. It's a lowercase h pattern. Just think of it as a down move with an arch that forms after that to retest the left side of the low bar. Now we've got silver, and silver is at 28.84 in the futures, down 10 cents. Platinum's down 7. High-grade copper is down at 3.49, down 1.20. You've got to keep an eye on that. Crude oil is down 51 at 91.5, and we've got bonds up 30 seconds at 141.03. Now, let me just show you. This is what my subscribers to my opening calls, my service here at TFN. In fact, I was just thinking the other day, I've been here 10 years, 10 years March. I'm almost sure that I started March of 2000 for my first opening call and the section that I call the Traders Corner, where we have our different stocks. So this is going to be an interesting year, because 2003 was also a very interesting year in the markets. Now let's go to this. What I'm looking at here, these are just very simple chart patterns. In this particular chart here, you're looking at, these are 5 sectors that I look at every day. And what we're looking at is that there's a rising wedge formation, and it says there could be a touch of the 14,114 area today. It doesn't have to, but it could be, just to complete the pattern that I call leg D up, and then we'll be ready for some kind of a pullback. That will say that the weekly chart of the Dow has made a new recovery high, and you can't get a peak until next week. In other words, it'll take an entire week from this week, Friday to Friday, before we will tell whether or not there's no new high bar. That's a high bar. The whole bar must make a new high next week. If, let's just say, somehow other the other indices also make higher highs this week, that'll extend their weekly charts as well. Okay. And I'm anticipating, based on this chart that we're looking at here, which is the Dow daily, had a high of 14,413.17 on Friday, and today's high is 14,402. No new high yet. And at this particular chart pattern, if you read textbook cases, they will say, oh, very negative, rising wedge formation. I say, It's a very bullish pattern, because it should pull back, but it doesn't pull back all that far. It might not even pull back more than, might not even be a third. In other words, it might only go down to the low bar with a doji candle of 14,276, which happens to correspond in the area to other things that we'll be looking at with moving averages. So this is so far, and the level of the rising trend line that we must watch on the 120-minute chart would be somewhere around 14,350. And we're at 14,395. So about another 40 points, 45 points to go. And then we start to test that trend line. My suspicion is, I can actually draw it in right now, is that we might make some kind of a pattern like this. Go down to the under 14,300 for a day and a half, day or two. And then we'll start to head back. Options expiration week, I'm expecting a very choppy week. We'll go into that as well in a little while. This is the volatility index, the 120-minute chart, and it is trading at $12.32. The low today is $12.26, and the recent low is $12.66. No, that's not right. The recent low is $12.49. So we're still somewhat under that. And let me just get rid of this. There you are. Remove the text. Yes, we're under it. We're at 12.26 right now. 12.08 was the low of consequence that we were looking at. That was the low of the 19th of February, before that very big spike in the volatility index and that sudden pullback in the market. Now, this here is a short-term trading index. Richard Arms, great great technician, developed this Trin Index. I use it completely differently, but let's just say at 0.84, it's kind of neutral. So that's the Dow at peak B, if there's no new high today, and this is the S&P at peak B. In the Chapman Wave methodology, and I want you to do this, let me just show you. Something that I do, which is this is the core. This is what, when we were looking at, I had a seminar, a live seminar here in the Boston area on Saturday, went from about 8:30 to about 5:30, and we're just looking at all these variations of chart patterns, etc. When the basic core of the Chapman wave is that when you take the lowest, most identifiable low bar, you should get at least a peak D, 4 peaks higher. Look at this. I'm putting an up arrow right there. Just for now, I'm going to change that to bright green because an up arrow needs to be green. You've got your green signal. Oopsie daisy. There we go. Color green. And then I'm going to put that in here to say set as default. Here we go. So the first peak was right there in November, around about the 26th. The next one is in later in November, and then you get the higher peak C, and then you get a what? A peak D. That is the core of the essence of this. This is how it developed 20-something years ago. But you can go higher, and in this case, you go 1 peak higher to peak E, and then what happens? The Dow pulls back very sharply. Pulls back, and it gets to what? A trough. I call them on the way down troughs, and we use lowercase letters, so immediately you can identify what trend you're in, and it says trend to the downside, 3 legs down. That's 2 troughs, little V-shaped bottoms. And then what happens? And then all of a sudden, you get the spiral. That was the last day of December into the first trading day of January. It goes peak A, peak B. You've got to be careful to identify these. That's why I love the black charts. I can see them so easily. The white background charts are great for subscribers to be able to print it out. And then it goes D, and it goes 22, E, F, E, F, and G. And then this is very rare. This is so unusual. You got a sharp decline that went to, you can never go higher than G. It's like if any of you are a pianist, you know that. If you're a musician, you know that you can never go higher than a G. There's no such thing as an H in music. It's the same thing here. And as a once former professional musician, that's kind of a significant thing for me. Just the corresponding pattern. So here we are. This is a single leg A, and I have a rule of thumb that the low bar cannot also be the high bar except in certain circumstances. So this is no bar of consequence except to the downside going up and down. And it turns out that it starts a brand new buy signal, which I believe we're in. That's why in my opening call, we have been long the Dow Diamond since a week ago exactly. Before the opening, I said buy the DDM 200% long because I believe that the bar that was just made, that there is an A. And if it's an A, in the Chapman wave, you should expect to go to a B, C, and a D if everything is in sync. I just wanted to show that. Now I'm going to show you some trend lines that are really important. I'll be back. Basil Chapman sitting in for Tom O'Brien and Steve Rhodes. I'll be right back after these messages.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
This segment is brought to you by Goldfields. For more information, just click the Goldfields banner on the front page of TFNN.com.
Bosses, Tom and Steve, it's my pleasure to be here. Usually my show is right after this, 11 o'clock till noon. For those of you just being introduced to this particular concept of higher peaks being graded and lower troughs being graded, this is the system that I use. It's called the Chapman Wave methodology. And in fact, what we're looking at here is the Dow making from the most identifiable lowest low on the 16th of November at 12,471. What does it do? It simply goes peak A, B, C. It should take you to a D. It takes you to D, and it can go higher, which is exactly what it did here. It went to peak E at on the 18th of December at 13,365. Comes back down to 12,883, and then it starts a brand new move, which goes, and this is very unusual, but it goes to the letter G. You cannot go more than a G. If you go to an H, you say, go back, you've missed something. It's just really unusual. This particular peak here, that single day low and high, that is an aberration in the waveform. It doesn't have, I can tell you when I say it doesn't happen often, especially with the Dow, I mean in daily charts going back years and years. I do believe I've seen it. I saw it once before, and I think it was in the Dow Diamonds, the DIA. But it doesn't matter. That's not a peak because you need a higher low bar. And it's exactly what happens on the 26th of February. It starts peak A, a pullback. It goes to peak B. And I'm saying to my subscribers, be careful. We are just about to pull back. I still expect us to go to leg C higher, whatever the peak B is, if it's today or tomorrow, whatever. I expect us to go to a leg C, then a peak C. a peak D, and then we've got to be careful. It can go higher, but at D, that's when the yellow light flashes. But wait a minute, just real quickly, and I've got a couple of emails here, and I'm going to get to them. I just wanted to show this particular technique. There are two trend lines that are very important here. The one is a trend line that sees the Dow already broken above, so I'm going to exclude that. And another is if I go from the lows, this is very important. Why? Because it gives me a sense, just visually looking at the top part of the trend line, from the low bar of November to the low bar of February. Almost everybody has this kind of software that you can click, and you should be able to get a parallel line. If I go new parallel, and all I do is I raise that to a point that appears to fit exactly the resistance levels. How this works is an incredible thing. Just as a visual, as an optic, it is extraordinary. My theory on this is that when fund managers look at a price and they say, oh, Walmart at 45, that's because they remember at 45 it was a difficult period, or it was a support level. But when you are moving 45 and then you go to, say, 55 and then 65, the horizontal level is really difficult. How does the market know to stop at these exact horizontal levels? Look, we've now got 1, 2, 3 points of contact on the upside. That's exactly how I love to draw these channels. If one crosses into a candle, that's fine, but I'm looking at the most points of contact. It says that the Dow has very strong resistance at 14,500 today. Tomorrow it'll be slightly higher, 14,534. But most importantly, there's a technique that I use. It's a very simple technique. In my CD, Introducing the Chapman Wave Methodology by Basil Chapman, I talk about these a lot. It's what I call an inside track. And what does the inside track do? The inside track essentially says you can draw another line. And what I do now, I've done this for about a year now, I've changed colors. Well, on the black background, it'll be green. I make the top line green because if it breaks out above that line, that's very important. That's beautiful. I make the bottom one red because if it breaks below it, it says, whoa, be careful. You're now underneath what was key support. But here's the trick. There's something else I do when I do this. I do another parallel for the channel. I make an inside channel. And that says whenever you get into the inside channel, watch, because that could in fact not be where you got to have fear. That could be where you want to enter the price. You want to buy whatever it is. And on the upside, I say, wait a minute. Therefore, if you've got that simple technique, you don't need ABCs or anything like that. All you need is to put that trend line in. Where's the best fit? Well, if you're looking at my charts on Tiger TV, and of course, this show will be archived on channel 10. My shows are archived on channel 11, although they're live on channel 1. Look, you are just about to hit the period that says, whoa, I hit that by mistake, that says at this level, that inside track is called a sell or repellent zone. This is called a propellant or buy zone. So I wanted to make it as simple as possible to say we're in a beautiful up channel. There should be a pullback. We should go to C. We should go to D. This is the line to watch. I'll be right back with the questions that I have at 877-927-6648. Please give a call. I'd love to hear from you, especially in this hour. That'll be a treat. I'll be right back. Downtown tennis.
Just recently, on December 28th, Market Insight subscribers were advised to go along the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91. And only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged leverage trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insights subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Hi folks, Basil Chapman. I'm back and sitting in for Steve and Tom in the Money Masters show. Dow's down 2.5, S&P's down 2. Very interesting chart patterns that we're looking at. Interesting scenario, and the scenario says, and I've spoken about this for it must be almost a year now. At one point, I said if the VIX, the volatility index, gets under 20s. Out of the 20s and into the teens, that'll be very positive for the market. And then I said if it can go into the mid-teens, that'll be outstanding, because the lower the volatility index is, everyone keeps saying, oh, that's the volatility index oversold. There's just no such thing as oversold in the volatility index in terms of looking at monthly charts, because you can stay in that oversold region. We were in the 9s at one point. You can stay there for a very long time. But if you use the index on a very short-term basis, that is really important. And then, of course, the short-term leads to the medium-term. Medium-term goes to the longer term. Is it important? Absolutely, it's important. And right now, it's at $12.26, and it says, I'm ready for a bit of a bounce. But I love the teens. That's basically what it's saying. And we're going to watch this really closely. I was asked about Zynga, Z-N-G-A. Zynga Inc. Class A. I should, of course, be able to tell you what Zynga is. I know it has to do with the Internet, but I don't use it, so I'm not sure. Someone in the den is bound to tell me exactly what it is. Doesn't matter. It is a stock that's trading at $3.82. It made a low most recently of $2.09, a double bottom low at 11.09 on the 9th of November and the 12th of November. So let me type that in, 11.09. That is, remember the lowest identifiable low bar? Well, the identifiable low bar we're looking at, 2 bars, is right there. With a little doji candle. Of course, things so low, it trades with dojis a lot of the time. But the lows that were established on the 9th and the 12th of November came after there was a flattening of the price. It was having a tough time making low lows. And also, most important, is that there was a huge gap for some reason, probably some disappointment, of course. On the 25th of July, it closes at $5.19 was the high, closes at $5.08. Next day, what happens? It gets cut 40%. $2.97 was the low. Gaps down. $3.22 was the high of that day. Well, that is resistance. Now, in my Master Trader series on Saturday, I showed some charts that had gaps, and the gaps were filled in the presentation that I had. And this is very important. We have seen. I really don't believe I've seen this kind of pattern this often, just in a really long time. Many gaps have occurred on the downside over the past 3 to 4 months, and a lot of those stocks not only ignored the gap afterwards, they made lower lows. They have just. I've talked about gaps being very important. Wide gaps are more important, of course, than narrow gaps. But when I talk about the gaps, it's just another technique. You can't sit there for the rest of your life saying, oh my God, there's a gap that's going to be filled if the price is moving up. The moment the price starts to turn down and the gap comes within eyesight, you better be careful, because it's like a 200-period moving average. It just sits there doing nothing until the price comes up to it or down to it. Then it becomes like a magnet. But look at this. The low of 322 was the high, right? That was the gap down. Yeah, 322 was the high on the 26th. So that was the low that was established immediately from the high of 720 on the 25th of July when it closed at 508. It gapped down and made a new. I don't know if you can call it a recovery low, but it's not a recovery, discovery low. And it continued lower for time, and now it's used up time. Look at the beautiful bowl formation that this has made. And it did have one spike all the way to the $3.75 double top, 11th and 12th of February. And in fact, if you wanted, you could almost do a left side, right side price time match to the previous highs. That's not the point here. The point is, you remember I was talking just a moment ago about the 200-period exponential moving average. Now, I believe in having a toolbox that is just full, so that at any point in time you're like a traveling repair person, and you don't want to go back to the office to go get the screwdriver, or, oh my goodness, the chisel, why did I forget the chisel? You've got to have all those tools, and at a certain point, you've got tools that have just been sitting, never used, haven't you, brand new out of the box, and you say, wow, that's the tool I need. Well, the 200-period exponential moving average, let me squeeze this chart. Do you see this? Right here. On the 17th of April, 2012, Zynga traded at a high of round number 11, closes at $10.31, and says goodbye to the 200-period exponential moving average. But I just noticed something which would be fascinating for those people who are new to this particular technique of the Chapman wave. Look at this. I'll expand it a little bit. You see this low bar right here, the most obvious lower left side low bar from after the IPO? Right here on the $8 round number close at $7.97 on the 9th of January of 2012, it starts a buy mode. And the buy mode goes to peak. Is that a peak? No, it's not. This is your first peak. Peak A, peak B, peak C, peak D, and what I call a rogue wave, right arm extension right there at E. I'll talk about that in a moment. You want to learn techniques? My CD introducing the Chapman wave methodology it discusses all of these. The right, that spike when the MACD, this is the MACD, this is the slow stochastic, two important tools. This is the maroon colored line is a 9-period exponential moving average. Look what happens. You've got peak D perfectly. That's exactly what you want to see. The fast moving average of the MACD, the stochastic above 80%. Everything's beautiful. And then what happens? I just want to check something. I do not like to miss any peaks. No, that's correct. What happens is it goes to D just like it's supposed to in the Chapman wave. Most obvious lowest low, left side, goes to the right side, and it goes to the fourth highest peak with all the technicals confirming. And then, if you use some of the techniques, for instance, if you use relative strength, you would have not have seen that there was a high bar coming here because it would have said going lower and lower and lower. But if you use a different technique, you see that blue line there? That blue line said right there with a volume spike, right at the high, at $15.91 on the 2nd of March. That island gap, I know it's not an island gap, 1462, 1460. Wow, it missed an island gap by 3 cents. That bar, that candle says, be careful, because look, if I draw a vertical line, let me put that vertical line in, bap, there it is. That vertical line says, at this particular point, the MACD was about to deflect lower. You don't know it's going to until 3 bars later, but it didn't make a new recovery high with the price. The slow stochastic was way down under 80%. Just a huge sign to say, yeah, you could make like a pattern, not one of my favorite patterns, but a pattern that occurs nevertheless, and it's called a head and shoulders top. The problem with the head and shoulders top is that very often, I'm not saying it doesn't work, I'm just saying it's not my favorite, because by the time you recognize it, you really want all the other techniques to be helping you, not this particular one, because look, by the time it breaks 1171, let's call it round about 1171, yeah, 1171 on the 9th of April, a big chunk of the decline has started normally. In this case, it was not just a big chunk, it was the start of a massive decline. So in my CD introducing the Chapman wave methodology, the technique that I use, which is called a rogue wave, and essentially says that if you go to the beach and there's a sign that says high tide at noon, that high tide at noon, let's see, just let me check that out. Rogue waves, 11A. I'm just trying to find it. Oh, come. All right, I'll find it in a minute. It essentially says that the sign at the beach might say high tide at noon. Well, it turns out sometimes that there's a particular wave, and that wave does not see the sign that says high tide at noon. In fact, at 12:06, just as you're sitting at the beach, settling yourself down with your blankie and your dark glasses and your suntan lotion, your favorite book, splash comes this wave, and what does it do? So yeah, on slide 269 it says rogue wave analogy. The sign of the beach says high tide at noon. At 12:08 p.m. you are sitting at the water's edge, reading a book and relaxing when splash! Suddenly you're soaked and wondering what happened. Well, the tide might have turned, but that wave didn't read the sign. And basically what we're looking at is there's a sudden spike up as all the technicals are pulling back. And that says, be careful. I got a cartoon that I drew years ago, and that cartoon says, I'm sure the tide is going out. And the next thing you know, this guy gets splash, and he gets almost drowned. And then he looks up and he says, never short the ocean. All right, well, let's get back to our story. So what we're looking at is from that high bar of 1591 back in March, first week of March of 2012, and then recently, August the 2nd of 2012. It makes some kind of a low. That low doesn't figure out. It just goes to a B minus, makes a pattern that I call the H that turns into an M. We're going to look at gold in a moment because it's doing the same thing. And then it makes a lower low to 11. Right now it's gone to 4 peaks, A, B, C, D. It's pulled back. There could be a continuation of that, but the MACD was so strong. I'm going to give the benefit of the doubt and say that this is peak A, B. No, I'm going to not give it the benefit of the doubt. I'm going to do this. I just need to take a moment here. Yes, this is going to be peak F because it has all the characteristics of a peak F top in the Chapman wave at $3.75, hit twice. Amazing how these makes double tops and double bottoms. Plunges down. That really is a plunge to $2.84 from $3.75. So, what, a 28% decline? And then it goes up to A, and it's in leg B. And the reason why I made a big deal about the 200-period moving average is because why? For the first time, the price is getting towards the magnet. It wasn't a magnet, it was a propellant. Now it is a magnet. I saw the word the other day. I've been looking for it for ages. When you turn the magnet round, it's first a magnet, but if you turn it around, it's a propellant. But someone I saw hit the exact word that I've been looking for years. I keep meaning to look it up. It is an attractor and a detractor. I don't remember, but what it says is it repels the price. And here we go. This is leg B, and at this particular point, it's come back to being a magnet. My target for Zinger is to test the $3.99 level, but that's not the issue. The issue is that the weekly chart has a potential left side, right side price time match in a cup formation. Let me draw the cup formation from there to there and there to there. That could take it by April, by the end of April, beginning of May, to the $5.15 to $5.25 area. How is it going to do that? It can only do that if at any point in the next 2 weeks it does not break the low of $2.84. A dollar low. It just cannot. First of all, I would say if it broke $3.26, the low of the 26th of February, I'd say be careful. This is just a rectangle formation. It's not going to get there. Could this be an alternate count? Absolutely. But the stochastic at 83% and the MACD is still very strong. And look at the MACD, the way it's been improving in the weekly chart. That's this middle chart. Folks, if you're looking at my charts, the left one is always the daily, the middle one is the weekly, and the right one is the monthly. And the monthly had a high of 1591, as we were discussing before. And that 15.91 is just sitting out there. I don't want to say that charts invariably make their way to back to all-time highs. That's not true at all. Until I get leg A and maybe a leg B in the monthly chart, I can't even discuss it as being in a brand new buy mode in the monthly. It's a really nice candle, but that's about it. So that's my assessment of Zinger, ZNGA, trading at $3.85. I think it's very positive. Nice spike up. I don't know why today. And I probably had time to go and look and see what it was, but I don't like wasting my time. This is a stock that's trying to get to the $4 level, and that's going to be the test of both strength and weakness, because the way it gets repelled, and even if it goes above it, it's just going to make a choppy move until it can establish that magnet of $4 to $3.93 is a springboard in the weekly chart to start testing this inside wedge, Chapman wave inside wedge, another technique I use, to if it can break at any point above this rising trend line. In other words, if it can get towards the 414 level, that'll be really positive. Why? Because it says, sir, you have identified correctly using your left side trough to the right side highs the resistance line that it wants to follow. I'll be back. Basil Chapman sitting in for Tom and Steve. Dow's up 4. S&P's down 1.14. And I'll be back. Buy the dips, buy the dips, buy the dips is the mantra. We'll be right back and we'll talk about that.
Are Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to tfnn.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of tfnn.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to tfnn.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of tfnn.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.
Catch Basil Chapman as he uses his Chapman Wave methodology to call the markets. The Tiger Technicians Hour, next on TFNN.
All right, folks, this is Basil Chapman, Tiger Technicians Hour, and I will be back in the following, oh my goodness, this is almost time. In another 8 minutes, 7 minutes, I'll be on with my own show. Okay, let me do this quickly. I'm going to show you the charts because it's very important. This is the beginning of the week. This is what I'm looking at. I'm looking at a potential peak C here with no new high today, and if there is a high today, it'll just be nominal on the Dow, and then I suspect we will be pulling back. When we get to peak C in the Chapman wave, it says that, yeah, you can expect a leg D to the upside, but it's where you want to start being cautious at leg D. Because why? That's where you don't have to, you can have the sharpest pullback. But if you're looking at the techniques that I use, first of all, this is the daily chart, and look at the S&P at 95%. That stochastic is really strong. If you're looking at the MACD, the moving average, convergence, divergence, that is very strong. If you're looking at the 9-period moving average, the support is at 14,242. It's 150 points lower. I don't think this is the move that takes us down there. I think this is a move that says peak C is going to come back. It might use time. Yeah, actually, I shouldn't say that. I think it could get close to the 14,242. Depends where we close. We could have another 30 points or 40 points up today. Then that would raise the base somewhat. But when I get to peak D, and the way I'm looking at it, I will be telling subscribers what I'm anticipating, because there's something different that's going on here that because of the pattern that I talk about. It's called the Chapman wave stalk leg formation. You've made a huge leg to the upside. You know how stalk stands on one leg? Then you've made the body. It's a little different because there's one aberration. You remember that bar that just smacked it down the 25th? It was down 210 points or something. Well, that was because of a rumor or something. Well, that's the bar that is a little different. But I still think this is the neck. And this neck is very important because it says when it's finished the neck, it should take a little time to make the head, and then the beak of the stalk comes down and invariably touches the top, or it just goes into the high of the body. And that would take you down to the 14,080 or lower area. So that when we get the D, and that's where I think we get leg B to peak B, in the weekly chart, and then says 14,000 is tremendous support. And so it says to me that we've got to be careful, because what I'm anticipating is it's the deepest and strongest pullback is going to come later, after the diamonds are actually in C, and the S&P, SPX.X, the S&P is in leg C as well with the Dow, so they're in sync, and that's really important to me. The monthly charts are still extremely positive. I'm not even going to talk about them. I'm bullish looking out. When I say looking out, I have to wait for leg D in the monthly charts, and then I will become very cautious if the technicals start to fail. That's number one. Number two is the weekly charts are saying that I suspect when we get to D, that's where we get. It could be April, it could be early May. That's where I think we actually, just on a time price basis, I believe that's where we could get the deepest pullback, double-digit pullback, not just what I'm expecting now in the daily chart, short-term for peak B and then maybe peak C. So we've got to watch this really closely. I'm going to watch it closely. And the reason being is that volatility index, actually, let me do this. We've got just a moment here before I go to my show. The Qs, the NASDAQ QQQ series, I've got it in leg F/B at the moment in the weekly chart. The monthly chart still needs to make a new high in. You see how beautiful this channel work that I'm talking about, this inside track, little mini channels working. It says that the NASDAQ could go above 70.58, the Qs, the QQQ Trust series, and then you get leg D, but you're going to an apex, narrowing. As the leadership gets narrower, it's matching that. Look at the IWM. The IWM has been the leader of the pack. Nobody even talks about this, but the IWM has been at all-time highs for a while now. I'm calling this leg C up in the IWM monthly chart, and leg C up. Everything's in sync. I think that we have our plan prepared. Let's see if it holds. I'll be back in the next hour for the Tiger Technicians Hour. Basil Chapman signing off for Tom and Steve. Dow's down 1, S&P's down $1.85, and I'll be back in just a few minutes. Call in. Love to hear.